Today's topic is how to start investing in the stock market. And I have 7 key points to guide you with this. Welcome to YourVibe Media. This is a channel where we talk businesses, finances, and personal growth. Back to our today's topic. Number 1, you have to educate yourself. You have to understand the basic concept of investing. You have to educate yourself on the investment vehicles and how to operate them. You have to learn the financial terms. You also have to understand the market trends and also understand the risk of investing. Number 2, you have to set clear financial goals. Do you want to invest for short-term gains? Do you want to invest for long-term growth? Do you want to invest for retirement? If you understand your financial goals, it will help you to set your risk tolerance. It will also help you to strategize. Number 3, create a budget and fund an emergency fund. You have to create a budget. By that I mean you have to create monthly budget that tracks your income or your earnings. It tracks your expenses. It tracks your savings, and it shows you your investment allocation. For your emergency fund, you have to save your first $2,000. And when you do that, pat yourself on the back. You achieved a milestone. It's not easy to save money. After saving this $2,000, you have to save 3 months to 6 months of your living expenses. If your living expenses is $5,000 a month, you have to save between $15,000 and $30,000. Your first $2,000 should be readily available. Your 3 months to 6 months, which is your $15,000 to $30,000, should be held in a high yield savings account. This is very important because you can earn interest. Your money will be working for you. But remember, everybody's monthly expenses will be different. In that case, people's emergency fund will be different. Number 4, you have to choose the right brokerage platform. Before you can invest in the stock market, you have to open up an individual brokerage account. With this individual brokerage account, you can become a player in the stock market. But you can only open that in a brokerage platform. Examples of brokerage platforms are Fidelity, Vanguard, Schwab, and the list goes on and on. You have to determine that this brokerage platform is regulated. You have to also determine that they are secure enough for you to execute your transactions. You have to determine that they have low fees, zero commission, no minimums. They will allow you to trade on fractional shares. They have educational resources, and they also have research tools. Number 5, diversify your portfolio. Every investment comes with a risk, which is the possibility of you losing your money or not earning the desired return. Investors will use diversification as a tool to mitigate risk. But remember, you can mitigate risk, but you cannot fully eradicate risk. You can diversify across asset classes. By that I mean stock, bonds, mutual funds, ETFs, which is your exchange traded funds. You can diversify across sectors. By that I mean energy sector, tech sector, healthcare sector, consumer sector, banking and financial sector, and the list goes on and on. You can also diversify across geographical location. By that I mean if you're a resident of the US and you invest in emerging market overseas, maybe in Asia, in Europe, in Africa, that is diversification across geographical location. Number 6, you have to start with index funds and ETFs, because this will give you instant diversification. It is not just one stock. Because you're new in stock investing, you need to first of all understand the market before you start trading in individual stock, because you need to learn a lot. Stock market is complex in as much as it's rewarding. When you invest in index funds and ETFs, you're investing in a basket of stock, not just one stock. And this index fund and ETF, they mimic the stock market index. Number 7, you have to monitor and adjust your portfolio. Because stock market is ever evolving, ever changing based on economic indicators, whether there's positive indicator in the market, which is when there's optimism in the market, or if there's negative indicator when there's pessimism in the market. All this will affect how the market goes. So you have to constantly monitor your investment so you will know if you need to change or reallocate your holding. Thank you so much for listening. I hope I was able to bring value to you with this video, and I hope to see you in the next video. And if you have not already done so, please subscribe to this channel and hit the notification button. Thank you again, and bye.